Hi George and Megan, thanks for coming along for financial advice. It's good to see that you're planning for your retirement earlier rather than later. Now, let's just go over how I see your current financial position. At the moment, you're contributing £8,000 each into personal pensions, which are now worth £140,000. Also, George, you belong to another personal pension and the balance there is £30,000. Lastly, you have £200,000 which George inherited from a family will. So, where to start? Given what I know of your future plans, your earning capacity and the cash surplus that you have at present, I'm going to suggest a combination of 3 investment strategies for you to think about. Overall, your portfolio should include investments which offer growth but which also give you some scope in terms of liquidity. Firstly, I think the focus of your financial plan should remain with pensions. Secondly, you should also consider a diversified share portfolio that would offer capital growth as well as dividend income. This will also give the potential benefit of the notional 10% tax credit on the dividends in the long term. Of course, some or all of the shares could be sold to satisfy liquidity needs. Lastly, George and Megan, to round off this strategy, I'd suggest that you purchase a buy-to-let investment property to take advantage of the tax benefits provided by furnished holiday lettings. So let's start with pensions. You probably know that pensions are very effective investment vehicles because the returns are compounded. They utilise pound cost averaging and they also allow you to use diversification and risk reduction strategies. The pension environment is really tax friendly. You've got tax relief on contributions, largely tax-free growth with the exception of withholding tax on UK and foreign dividends, and 25% tax-free cash when you crystallise your benefits at normal retirement age. All of which should give you higher returns compared with other investments once income and capital gains taxes have been met. Also, the normal minimum pension age rules ensure that the investment is kept intact for a long period. Pension investment is really very safe. You might not have a cast iron guarantee for your returns, but the Financial Services Compensation Scheme, the Pensions Ombudsman, the Pensions Regulator and Her Majesty's Revenue and Customs all provide safeguards for your funds. On the downside, you have to consider the annual allowance tax charge and the standard lifetime allowance tax charge, but I can suggest some strategies if these become a problem. Now, there is another option when it comes to personal pensions. The alternative to contributing to a multi-manager fund is to manage your own. These self-managed plans are called self-invested personal pensions and give you the advantages of greater flexibility and control. However, be aware that you could find yourselves with the responsibilities and liabilities of acting as both trustee and scheme administrator. This will mean you have to maintain up-to-date knowledge of Pensions Act 1995 and Finance Act 2004, as well as regularly review and update pension scheme documentation to reflect changes in pension legislation. Look, there are a number of other issues to think about with self-invested personal pensions, and it might be best to meet up next week to discuss this option in a bit more detail. So, George and Megan, pensions should be the focus of your financial plan. I'd suggest that you build on the £140,000 balance in your existing pensions and transfer George's other fund of £30,000 to combine it with his current plan. I think you should each also contribute £60,000 net from George's inheritance into your pension plans. After annual allowance has been carried forward from earlier years and the contributions have been grossed up to £75,000, that would give you a total value of £320,000 in your pension plans. This leaves the remaining £80,000 of your inheritance. We need to consider whether shares or property offer the best prospects. I'd recommend both for a well-balanced retirement plan. So that brings us to our second strategy, shares. In the past, the share market has outperformed other classes of investments such as property and cash, and a portfolio of shares is appropriate, I think, to your risk profile. You could start up a portfolio with about £40,000 worth of shares in blue chip UK companies. I'd recommend this rather than going into the emerging market shares, which seem to have dominated the FTSE and local stock exchanges recently. The dividends that you get from UK blue chip companies tend to pay large and increasing yields, which increases the real return of your investment. Blue chip shares may not have matched the huge profits of the emerging market shares lately, but I think that your strategy should be growth rather than profit taking. There's a lot of evidence of increased volatility in the emerging market area, so the value of these shares doesn't look too promising in the longer term. Now we get to our third strategy, property. At this point, we've £40,000 remaining of the inheritance money, but it's still possible to invest in property. Property investment has a very good track record over the long term and is also the less volatile than the share market. I think you would both do well to buy a residential unit or apartment with 90% gearing to take advantage of the tax benefits of furnished holiday lettings. High income earners paying high marginal tax rates like yourselves and who aren't risk averse can really take advantage of all the tax incentives that come with furnished holiday lettings, such as plant and machinery capital allowances, entrepreneurs relief and also rental income being classed as relevant earnings for pension purposes. So, George and Megan, I've given you both a lot to think about. It seems to me that the combination of pensions along with a diversified share portfolio and a furnished holiday letting should give you a nicely balanced retirement plan. Now, I'll sit back at this point and let you ask the questions.